The IMF warns of a stock market crash. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's have a look at this article from The Guardian about the IMF warning of a potential stock market crash or risk of triggering a stock market crash unless the support payments and money just keeps flowing. Let's jump over here to trading economics. We can see the Dow Jones is at 31,547 at the moment. The S&P 500 is at 3,881 and the Nasdaq is at 13,186. They're all, well, close to or at all-time highs. The Nasdaq has come down a little bit, and that could be, well, Tesla has lost a bit of its shine. Ooh, look at that, under $700. So some of the more exciting tech stocks are starting to pull back a little bit. You're brave enough to short it, guys. Let me know in the comments. So let's have a look at the IMF's warning and what it means. So governments and central banks must maintain their pandemic rescue programs or risk triggering a stock market crash, the International Monetary Fund has said. Warning that there were legitimate concerns about a share price bubble. The Washington-based organization said that without continued low interest rates and government subsidies, it was possible a correction in stock markets would occur. Well, wouldn't that be good? You could all get shares that don't have price-to-earnings ratios of 1,000 and above. Maybe companies that actually pay a dividend will be attractive. Oh, Florian, I'm being too old-fashioned now. Making a profit is so old school, isn't it? It's a clown world, guys. It really is. It's just insane. In a report issued to coincide with the World Economic Forum, the IMF said investors had ignored recent data showing major economies slowing as the pandemic persisted through the winter months. Well, how many people are stuck at home? What are they going to do? They've got no way of making money. A lot of them are trying to just chuck it in the market. There was also the prospect that vaccination programs would take longer to deploy, especially across the developing world, forcing governments to maintain restrictions for a longer period. Financial markets have rebounded since last March, and some have soared to fresh heights. The S&P 500, which accounts for a cross-section of the largest 500 US companies, slumped by a third last spring from a high before the pandemic of 3,386. Since then, it has climbed to 3,849, up more than 13% from the level in February 2020. As the world has a pandemic and economies are being forced closed all over the world, the stock market's going crazy. I mean, how many people are just taking their stimulus money and throwing it in the stock market? Or how many people are having less money to spend? Because remember, here in Australia, you're seeing the story of people that have saved more money because their pay packets haven't adjusted. They are able to work remotely, work from home, so they can still do their work, and their costs have gone down. In some ways, Bolt was right with regards to smashed Ave, people spending excessively, really cutting back to save. So, the FTSE 100 in London, which was at 7,500 in January last year, and has struggled to recover from a drop in value of 2,500 points. It grew to a year's high of 6,873 earlier this month, before sliding to 6,638 this week. Tobias Adrian, the IMF's head of financial stability, and his deputy Fabio Natalucia, said in a blog to accompany the report that investors were able to bet on a persistent policy backstop and that a sense of complacency appears to permeate the markets. They said a herd mentality had gripped markets, which meant the majority of investors were ignoring warning signs of an economic slowdown and a longer climb back to a pre-pandemic levels of activity. Or could it be, because we can see, if we jump over here, one of the headlines on trading economics, Powell signals easy money, policies to remain in place. So the Fed printers are going to keep going. There's going to be more money being, pumped into the economy. And then when you have more money pumped into the economy, you have the candle-on effect. It refers to the change in relative prices resulting from a change in money supply. The change in relative prices occurs because the change in money supply has a specific injection point and therefore a specific flow path in the economy. Here in Australia, a big part of that is housing. It's housing. Every time someone borrows money for a mortgage, that's money supply created out of nowhere. The government incentivizes that. How much of that is flooding into the stock market in the States. So this raises the risk of market correction or repricing, or we could have a crash like the Great Depression, everyone. That could be coming too. Where are we seeing it here? They said a sharp, sudden asset price correction, for example, as a result of persistent increases in interest rates, would cause a tightening of financial conditions. But is it even going to... I mean, we've had this before. When the Fed in the States tried to normalize rates, it was impossible. Are they going to have to buckle eventually and do it? That's the question. This could interact with existing financial vulnerabilities, creating knock-on effects on confidence and jeopardizing macro financial stability. They said this left central banks with no option but to maintain low interest rates and governments to continue state support programs, because to reduce their scope or generosity would cause a panic among investors. The report said a short-sighted approach to vaccinations that restricted access to developed countries was a particular threat. Delayed access to comprehensive healthcare solutions could mean an incomplete global recovery and endanger the global financial system, with emerging market economies accounting for about 65% of global growth, now 40% excluding China, over 2017-19. Delays in tackling the pandemic in such countries may bode ill for the global economy, it said. Supply chain disruptions could affect corporate profitability, even in regions where the pandemic is under control, and because growth is a crucial ingredient for financial stability, and even partial recovery risks jeopardizing the health of the financial system. So there we have it, everyone. Some concerns regarding a stock market crash coming from the IMF, and essentially advocating for more of the same. More stimulus, more government support, more low interest rates. How long are we... I mean, Australia's just following the herd. How long are we going to see our interest rates at 0.1%? Some people are saying, wait till we get high rates, all these people are going to be smashed out of the housing market. Is it going to be possible for them to increase the rates, guys? They're trapped now. You know, will they? The question is, I wonder if we will see negative cash rates before we see an increase. Do you think we'll see that? Maybe I'll jump over here. ASX rate predictor. We'll jump over here, the rate tracker from the stock exchange. And what are we having here on the 23rd or yesterday? 74% probability of a decrease to 0.00%, 26% no change. I wonder if we're going to see that, a drop to 0%, and then will we hit to negative? Even though our own governor of the Reserve Bank has said that a decline, negative interest rates don't really have an impact on increasing people's spending. If anything, I think the psychological damage to the economy would be even greater. Consumer confidence would get smashed if we went negative. I remember reading things about, you know, the housing sector and the market when 3% was considered an emergency rate, guys. Look at it now, we're at 0.1, and I update my chart. You know, I actually went and updated this chart, guys. Do not think I didn't. I actually went in there in November and updated it because I need to, you know, copy pictures and put them in the right folders so I can refer to it on my software here. And you can't even see the bloody thing. If you look at it, you can't. It's like one pixel. One pixel there. So I'm kind of annoyed. We need to go negative, so it's worth me updating my chart, I think. What do you reckon? So guys, I mean, there you go. Calls from the IMF and warnings for a potential stock market correction, a crash. Will they ever be able to raise rates again? Let me know your thoughts and opinions in the comments down below. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join the channel on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. You can also support us by joining MeetRx or SelfWealth and helping us out those ways too. Take care, guys. I'll see you next time. Bye for now.